Let's answer some questions from the last market outlook. I am still in the financial folder, specifically in agency. I still haven't been able to connect the dots, specifically in repo market, but the machinery would be good. Oh, for industrials. I think it would be a good idea to create a file in the financial folder explaining repo markets. There is a question later on asking what's the difference between repo and reverse repo, so I'll draw it out quite simply for you. You have investors, whoever they happen to be, households, institutions, whatever the case is, and they have extra money, so some of that money goes into money market funds. And money market funds have to earn a return on that without taking on any duration risk, just a cash return. Sometimes it can't find enough securities to do that, and sometimes it ends the day without fully deploying all of its money. So what it does is it lends it to the Fed. And the Fed will give it securities, and it lends the Fed cash, and it gets securities in return. Then you have hedge funds and other dealers up here, let's say, and they buy treasuries, U.S. treasuries, and they're holding on to treasuries, but they don't really want to pay for the whole thing. They want to get some leverage out of this. So what they'll do, they'll buy these, and then they'll finance them in the repo market. They give securities, and they get some dollars back. Notice the flow. Dollars from money market funds finds its way into the Fed, and those dollars finds its way into the hedge fund dealer community who buy the U.S. treasuries, who post that as collateral to the Fed, who then give it to the money market fund. Reverse repo, repo. And in a very simplified way, that's it. Took my level 1 exam this morning. Okay, previous education. First, do you intend to cover industries like this? Biology and ecology. Well, I'm doing understanding pharmaceutical supply chain now. I've done part 1 and part 2, which is manufacture, and I have done distributor. All that's left is the PBM. All the screens and everything are done. It's just finding a time to narrate where I have, where I can be uninterrupted for 2 hours or so. But that should be up by the end of today, which is Wednesday, November 15th. And then those 3 will be available. So yeah, I do cover that. Forest resource management, not really, but I do cover timber REITs. And I do get into detail about how to assess a particular amount of acreage for its growing potential, the type of trees that you would be looking for. Would you be covering alternative investments as a whole? I'll go into more specifics. Yes, I did timberland. This other stuff here, as I already replied to you, this is stuff you probably learned in your forest resource management course. I don't know why you'd want it repeated to you. I think it's more important to see, well, how does that apply in an investment now? Have you been tracking lumber futures lately? No, I haven't. I guess I could just end that one there. I haven't, so I wouldn't have an opinion on it. Does one of the applied series models cover business model analysis? When I do a video, let's say understanding mining, we will look at a particular company like Freeport, and we will look at how Freeport makes money. In other words, you have copper that's in the ground. How does it get it out of the ground, and how does it make money in doing that? So yeah, to the extent that we look at different companies that are doing things, you do cover their particular business model. But if you're looking for just a more generic process of how do you assess a company's business model, in CFA, I think it's either at level 1 or level 2, you have a reading on business model analysis. Which modules are currently available? You could just go and download the PDF for the applied level, and it will give you all that information. Just go to markmeldrum.com, click on applied level, and you'll get the pricing grid up, and right below that are 3 PDFs. They're the same PDF, just in different languages. About aerospace, considering the geopolitical situation these days, would you recommend getting information such as market shares, industry growth rates, industry margins for a retail investor without access to third-party proprietary research? How would you recommend getting information from the company itself? The 10K. Usually there is some outlook, and usually there is some, analysis of the economic situation. You'll get a lot of information from the companies themselves. You'll also find when they're giving you that information that they may reference certain sources that they're using for growth rates in China, let's say, growth rates in Europe, growth rates in Japan. You'll get some of that. Industry growth rates you can get from GDP, from any country's GDP report. It'll break down GDP by industry, and you can look at how GDP grew by industry, by sub-industry, year over year for any particular country that you want. Industry margins would be a little bit more difficult to get there. It's not that there aren't sources that would be available. There would be sources that are available. But it would start, I can't tell you for every company what source to use, but you would start with the company's 10K, the annual report, not the quarterly. The quarterly really just tells you how the quarter did. The annual report gives you a whole view of the company. And in there, you'll find sources. So if you have a particular industry, there's 2, 3, 4 major companies in that industry, go through their 10Ks, you'll get a lot of good information. Level 3 course. Do you recommend starting at one's weakest section or starting at the beginning of volume 1? Are the volumes independent or do the volumes build on one another? No, they don't build on one another. They are pretty independent. So for level 3, I think you can either start with the difficult sections first or the easy sections first to build momentum. I prefer, whenever I'm going to do something, give me the difficult stuff, because if I'm not going to make it, it's not going to be because of the easy stuff. Let me find out soon enough where the problem is. Let me get through the difficult stuff, because if I can get through that, then everything else is easy. How can we grow faster the portfolio, keeping yearly contribution same as before? Well, you have to have positive returns. Right? If you have a portfolio and you've invested it, let's say at a higher level, 60-40, and you are just going to passively invest, you're going to buy an index to track the market, buy an index to track bonds, and have an annual contribution. Both those sectors, the bonds and the equities, will throw off income in forms of interest payments and dividends, of which you then reinvest quarterly. And over long periods of time, they appreciate in value. That is, if you're buying bonds at discounts, you'll get the yield on the bonds, and equities have a long-term track record of price appreciation. So it's just it's discipline and patience. First machinery, then media and entertainment. I think machinery, cat and deer are interesting because they have sectors that are leading indicators for the global economy, and they are global, so they make nice indicators. Can you do one on trading in industrials? Yeah, I'm doing industrials. It's either industrials or communications next, but industrials and communications will be done. It's just, do I do industrials next, then communications, or do I do communications next, then industrials? I'm indifferent. Do you cover U.S. municipal bonds anywhere in the applied series? Not really. Muni bonds have risk. They're tax-free. That's about it. But I don't really cover municipal bonds. I think this is just something that you can Google and get information on anywhere. There used to be some older CFA content that was included in the applied series. I don't know what you're referring to when you say there used to be something, specifically fixed income. I don't know what we're referring to here. Vote trucking. Okay. If the productivity is increasing in a deflationary environment, do you think the fundamentals of equities can be justified by that? Absolutely. That's the point, is if you have productivity that's increasing, creating negative unit costs, that means margins are increasing. Because you are now producing each unit at a lower and lower cost because your productivity is increased. Instead of producing 10 units, the same amount of capital and people are now producing 15 units. So if you're dividing the cost of producing 10 units with now 15 units, your unit cost will be lower. And if the selling price stays the same, then margins increase. With lower unit costs, it does allow the producer to lower their costs to keep their margin the same and gain market share. Either way, that's a winning proposition. So yeah, equities can be justified, but let's understand where, when we say that you have increased productivity, that's usually done at a national level, at a GDP level. You would have to look at productivity by industry to see whether a particular industry is gaining or losing on its productivity. Real actual yields rose week after week, and this is noting that unfortunately, for some reason, when I went to the real yields, the spreadsheet did not flip the last week's real yields into the week before. So it's comparing 2 weeks, week over a 2-week period, not 1 week. My mistake on that. Anyone know an optimal way to run through it? The applied series, anything you want. It's not designed to be linear. So let's say that you look at, for the portfolio construction module, you pretty much have to start at week 1. You pretty much have to start there. For the options, you pretty much have to go through the basic option strategies first, understand call, long call, long put, short call, short put. But then after that, you can go into volatility strategies, income strategies, directional strategies, whichever one you want. The sector studies, just grab whichever one you want. There is no order for the sectors. Assuming a 20, 30-year time frame, which do you think will outperform, Triple Q or SPY? Triple Q. Triple Q, hands down. Over a long term. Yeah. Can you walk through the Tuesday inflation numbers and discuss how it may change your strategy on holding long-term bonds, CLT? It doesn't change anything. We live in a deflationary world. Technology is deflationary. High interest rates are deflationary, or at least disinflationary. So the question we have to ask, number one, is are rates high? The question is yes. The second question we have to ask is the pace of technology reversing? Is technology slowing down and we're going to use less technology in our lives, or are we going to use more? If we're using more, if technology is just finding more and more roads into lives, the answer is yes. The combination of these two are absolutely deflationary. This is disinflationary. This is disinflationary. When you have a bunch of disinflationary forces, you will have a backdrop of deflation, which is what we have. Now, you may have inflationary pressures in some places like housing, because there is a structural shortage in both Canada and the US. When I say structural shortage, it doesn't necessarily mean that there's a shortage by, just a census of the number of houses and the number of people saying, look, if you divide them all, everyone's got a home. Yeah, but what if I own 6 homes and I don't want anyone living in them? Then there aren't 6 homes available to live in. Yes, I have 6. Yes, the physical count shows there are 6, but no one's going to live in them. They're mine, right? So as far as available places to buy or rent, there is a structural shortage in both Canada and the US. More so in Canada. So you'll find some sectors that are inflationary, but overall the backdrop is deflationary. So I think with yields, I was buying these bonds with yields over 5%. I think that makes sense all day long. My only regret at this point is having not bought more. What's your allocation factory on SPY in your applied series? I'm curious how you would apply this strategy given the inverted yield curve and looming recession. Would you sell puts further out of the money or simply not employ the strategies till after a large downturn? Well, the idea behind an allocation factory is you want an allocation anyways. I mean, if you're trying to time the market, you have to ask yourself, are you doing it for income or are you doing it for an allocation, right? If you're doing it for an allocation, what do you care? What do you care which direction anything is going in? You said you want 1,000 shares. I'm going to show you how to get 1,000 shares at a price better than the market over a period of time, because you should dollar cost average into a position over a period of time. I'll show you how to get that done. But if you're going to say, well, I want 1,000 shares allocation. However, I want to time the market now. Well, then maybe you're more concerned about the income. Maybe you're trying to generate income on the puts and not have anything put to you. If that's the case, then yeah, this is the wrong environment. If you have a market with downward pressure or a highly volatile market, it's hard to use that underlying to generate income. But if you're doing it for allocation, who cares? Who cares if it's put to you every single week? It wouldn't matter. You wanted the allocation. So I guess you have to ask yourself with your question, what is the outcome you're trying to achieve? Is it you want to generate income but not own the shares? Well, then that's income. And yes, SPY would probably not be an appropriate thing to use. If it's because, no, I want 300 shares or I want 400 shares or 500, then yeah, it doesn't matter. Let's see. You mentioned taking games on home builders if yields will continue to be under pressure. And they weren't. And man, did the home builders explode on Tuesday. I don't know if you saw some of them. Anywhere from 6 to 10% up on the day. Is it correct to say then that if we believe yields had peaked from the time being, home builders have more room to run? Yes, that is what I'm saying. Applied series subscriber, my vote is industrials, but aerospace and defense. Any comments on the potential government shutdown in the U.S. this Friday due to the elevated clown risk? It looks like they got it done. They got an extension. Did the negative outlook get a quicker resolution? Also, what do you think is the best historical performance time period to look at when evaluating investment? 3, 5, 10? It depends on where in the life cycle the company is. So let's take the life cycle approach. Where you have different phases. There's your maturity. There's your decline. There's your growth phase. There's your introduction phase or youth phase. If you're looking at a very young company, there's not really a very good look back period. For a very young company, it's really about the story that you can tell. For a growth company, to set the growth trend, 2 years, 3 years, you're looking at 8 to 12 quarters perhaps. A mature company, you can go longer, 5, 10 years. And look at trends over a longer period of time. And a decline company, you're going to have to shorten that as well, because if you go back too far, you may create what's called a value trap. So you want to shorten this. So this would probably have the longest look back period. This, I would say, I wouldn't even worry about the look back period. I would look at the story that it can tell. In the growth, would probably have a shorter one, 8 to 12 quarters at the most. Not too much trouble. Can you please explain how the 4.04 on high yield OAS is arrived at? So it's basically take a high yield bond, let's say a 5-year high yield bond, and it's got a 10% coupon, and you look at a 5-year US Treasury and it's got a 5% coupon. The OAS would be 5%. I'm doing it in a very naive way. The spread would be 5%. The OAS is calculated differently, but let's say that this has no options in it, and there's no options in any of these. The OAS, the option adjusted spread, would be 5%. It's just the number of basis points you get for the credit risk, not the interest rate risk. Okay, so when you buy a corporate bond, you are getting both interest rate risk and credit risk. Interest rate risk is captured by duration. Credit risk is captured by spread duration. And of course, that's built up from a combination of the probability of default and the loss given default. But that's all it is just the compensation that you would receive above buying a comparable treasury. At what level do we say the spreads are reflecting high risk as they did back in COVID? For high yield, a 500 is considered about, sort of about an industry average, 500. Call it, sort of an attractor point. Below 500, credit spreads are tight, meaning that it's expensive to buy corporate bonds or high yield bonds because it is below 500. Anything above 500 makes it cheaper. 800 is a sort of recession territory. When they spread out to 800 or above, it's usually a good buying opportunity. PPI data today showed a significant cool down, reinforcing disinflationary trend that appears to be favorable for long-term treasuries. Surprisingly, TLT has experienced a notable sell-off. I'm quite puzzled by this. So am I. And the reaction happened right at 8:30. So the chart was like this, and then you had an increase in yields followed by that almost right away. So it could be that maybe there was a seller who waited for strength and decided, I'm going to sell into strength. Yesterday was strong. The market went up, and maybe they waited for PPI or thought PPI would be strong as well, and there would be just one more pop before they sell. I don't know. It is not consistent with yesterday's action. Now, yesterday, you could have just said, well, yesterday was a really good day, but that probably forced a lot of short covering so that the volume was overstated yesterday. There were way too many buyers yesterday, and that yields didn't deserve to go to that level, and that this represents a more rational market without the short covering, that this is where the market is pricing yields. You can make up any story you want. There's a whole bunch of stories that fit the data. Thing is, nobody really knows. Nobody knows what's going to happen. So that if I told you at 2 o'clock this news is going to come out, what's going to happen to the dollar? What's going to happen to yields? Flip a coin. So you can think, well, in a textbook way, it should do this. Sometimes it does. Sometimes it leans towards those tendencies. Other times it does the exact opposite with conviction. This is with conviction, the exact opposite of what you think you would expect with conviction. Nobody knows what's going to happen. Nobody knows what's going to happen. Even deep in the heart of Goldman Sachs or JP Morgan, dive deep in there, go into the secretest of the secret rooms. Nobody in there knows what's going to happen. It's all just guesses. It's all educated guesses. They're best guesses. Some people are better at guessing than others, but nobody really knows what's going to happen. All we can do is say over a longer period of time, the tendencies tend to work out, but over short periods of time, all sorts of funny things can happen. So if we think about yields on the 30-year, yields will over time drop. I don't know what the attractor point will be, but yields will drop. But in the meantime, they'll do all kinds of stuff like this. So it's the longer term trend we want to pay attention to, because there's a bunch of noise. This could be a result of yesterday, which went too far, and it should have done this yesterday, so it went too far. Now it's retracing. It could be that a seller has decided to sell into strength. Who knows? Have you come across any information that might explain the bond sell-off? Nope. But if you ask me, have you come across something like this before? I can't tell you how many times I've come across something where the market reaction to something is completely opposite what you would have thought and what most people thought, and you're left just scratching your head going, what's going on? Like, what's going on here? I don't get this. Do I need to be a CFA to understand your sector studies? No, but, well, it helps, right? I mean, if you have some financial education, well, clearly that would help. But no, you don't need to be. Are there many industries per sector? Yes. Do you plan on covering just a few, or the plan to cover more and more as time passes? This is where the focus is. In everything that I've done in the applied series, nothing and I get messages from subscribers all the time. Nothing has been as overwhelming as the messages I get from the sector studies, understanding mining, understanding electric utilities, understanding banking, understanding REITs. Nothing has been more overwhelming than that, which tells me I found where the market is. Whenever you introduce a new product or a new service, you have an idea of where the market might be, and you introduce something. Well, what if the market is over here? So you have to learn to pivot over time and say, aha, now I found the market. And everything you do, every new product or service a company introduces, doesn't always land in the market they want. The product or service has to evolve. The definition of what they do has to evolve. The definition of the customer has to evolve, and you have to find that spot. And that spot is, it seems to be the sector studies. So yeah, there's a lot of industries and a lot of sub-industries. So you have a sector, you have an industry within a sector, and then you have sub-industries. So a sector may have 4 industries, and those 4 industries might have 12 sub-industries associated with them. So yeah, the plan is to cover as many of these as I can, and that's basically where the focus is going forward. Considering the macro outlook being opposite throughout the year, would you do a year-end price target on SPX, year-end target? No, I have no idea at this point. Maximum uncertainty. So I can give you a range on the SPY. We're at about 4,500 today, so I think we'll probably end the year either somewhat higher or somewhat lower. Same with yields on the 30-year. Yields will end the year either higher or lower. That's the best I got for you. I know that's not exciting, but that's the best I got for you. Now, my range of the high and the low point will get tighter and tighter as we get closer to the end of the year, so that on December 31st, in about 5 minutes from market close, I can be pretty precise. So if you want to check in with me there, I can tell you probably within a few points where the index is going to end. I've never had this level of uncertainty about what's going to happen next, because it just seems the days are filled with sometimes responses to things that make no sense, or price directions on some stocks that seem to go counter to the information the company is supplying. I have no idea. For industrials, can we do a deep dive into railroads? Any of the class 1 would be great, as they are also canary in the coal mine for the economy. That's true, railroads are. Should GM Ford bondholders be worried about holding bonds until maturity? No, because ICE has big cash flows. So I wouldn't worry about it. The company still will produce significant cash flows. It's just, will those cash flows eventually die? Or will those cash flows grow? Because to get to free cash flow, you have to subtract CapEx, and will that CapEx have a return on its investment? Not only that, if the car companies do well over the next 3 years, the union's just going to show up with yet a bigger knife. And even right now as I do this, the last headline I saw was the union is likely to reject GM's offer. Even after all of that, even after a record deal for the employees, which was negative for GM, it looks like they're going to reject that offer and get out not only more knives, but baseball bats. Somebody needs to protect management and all this from the excessive force of the union here. It is time to get the heavy boot of the union off the neck of the oppressed investor. Do you see any value on banks' capital market assumptions? Again, nobody knows the future. These are assumptions. These are assumptions on which they base a lot of their wealth management division on, and that side sort of builds their strategic asset allocations on those capital market assumptions. And a strategic asset allocation is a very mathematical, precise result of a bunch of assumptions. So you give me a bunch of your assumptions, which Maybe right or wrong, nobody knows. Nobody knows. They're all guesses. You give me a bunch of good guesses and I'll give you a very precise asset allocation if those guesses were in fact true. If they turn out to be exactly true, this was the best that you could do. But those guesses never turn out to be exactly true. So any strategic asset allocation is not the best you can do. It's good enough. It's just as good as any other allocation, really. To which extent do you think a possible unwinding of the carry trade represents a risk for the U.S. bond or general economy? I don't know that. You see, I can't make the connection to the bond market, because in a carry trade, let's say you have Japan here and you have the U.S. Over here. Interest rates on cash negative 0.1%, but you're going to pay more than that. Let's say you're going to pay 1% to borrow cash, but you can invest here at 5.4% on 30 days. When you borrow a sum of yen, there is no risk in that sum of yen. You borrow 1 billion yen, you owe 1 billion yen. That's never going to change. You owe 1 billion yen and you'll pay an interest rate. If you buy, 10 million of US T-bills, you will get 10 million with a yield. The risk is in the exchange rate between the two, the spot rate between the two changing. You don't want the yen to appreciate, because then you're going to need more and more US dollars to pay back that billion a yen that you borrowed. So all the risk is in the exchange rate. What you don't want to do is introduce risk in the investment. So if you buy treasuries, you now have duration risk. What you do not want is the yen strengthening, but long-term bonds having sold off, because you'll have fewer US dollars here, but you're going to need more US dollars to pay that back. So you're going to lose because you need more US dollars. And you lost US dollars. So you're introducing two risks to the carry trade. So carry trades usually like to stay with one type of risk, which would be the exchange rate risk. So if there's an unwinding of the carry trade, there could be pressure on money market rates, which may then bleed into longer term rates, but there wouldn't be selling of 30-year bonds to cover a carry trade, because that would be a dumb destination for your funds. If you have exchange rate risk in that trade, it would be stupid to take on duration risk at the same time, unless you have a clear view that rates are going down, that the central bank has already started to cut rates. Then you'd want duration, but we're not there. So I don't know that it would be a risk to the U.S. bond market, maybe the money market. If trade unwinds, a direct impact would be U.S. rates increasing. An indirect, not a direct, an indirect impact would be a possible indirect impact is a more correct way to say it. From there, I guess the degree of spread and spillover would depend on how much the market can absorb the increase in rates. So you're continuing on the assumption that it's going to hit the bond market. So all of the rest, I think we can pass on. How would you start analyzing the situation, finding an estimation of the trade size? Well, for yen, I don't know that we have to worry. Their GDP, which came out last night on the 14th of November, their GDP is negative. They are, teetering on contraction and recession. Given their population demographics and shrinking population, this is not surprising. And I don't see that reversing anytime soon, which means monetary policy in Japan is probably going to stay this way for quite some time. The risk is intervention, is central bank intervention. Now, if you get central bank intervention, then yeah, you might have some selling of bonds, because they're not going to be all in money. The central bank reserves aren't going to be all in money market funds. They'll be in some 10-year, maybe some longer bonds. But then if there's intervention, the central bank's got to come up with US dollars to sell. It's going to liquidate some of its treasury holdings, sell those US dollars to buy the yen to support the price of the yen. But I don't see an unwind from the fundamentals coming unless the central bank changes its monetary policy stance, printing a negative GDP number. I don't see that happening anytime soon. Wondering what your opinion would be on why the Canadian 10-year yields are lower than the U.S. 10-year yields. The Canadian market is a much smaller market, and it has historically been the case that our yields have always been below U.S. yields in interest rate increasing environments, simply because the Canadian economy is far more interest rate sensitive than the U.S. economy. So if we think about a yield curve, you have money market rates, and then you have your yield curve. I'll just draw it out simply so we have an inverted yield curve. All the money market rates will reflect monetary policy. It's once you get out to the capital market curve, the 2-year will import some expectation of monetary policy, but the rest of it really is a reflection of expected real GDP and inflation expectations. And in a country with a high level of interest rate sensitivity, as monetary policy pushes up money market rates, the belief is that they will work faster with less of a lag, and you are going to get a recession. So real GDP will be lower, and nothing kills inflation like a recession, so that the yields will begin to reflect the fact that this country is probably facing a recessionary environment much sooner than the U.S. would be. So because we have a much smaller bond market, and because we have a much more interest rate sensitive economy, it is usually the case when you have rising rates on central banks that Canadian yields are below U.S. yields, because Canada is believed will enter the recession first. What do you think of a 60% triple Q, 30% Berkshire, 10% XLE buy and hold forever approach? Well, you're all stocks. You're all stocks. If you're 25 years old, maybe. But what I would say is take your 60, 30, 10, and have an allocation to equity and bonds. If you're 25, you can go 20, 80. If you're in your 30s, I would go 30, 70. Don't ignore this, because it is like a stabilizer to your portfolio, so you can avoid big drawdowns. You'll still have drawdowns, but you'll have less. And of the 70%, you can divide it that way. So if you had $1,000, $700 will go into equities, 420. If you're putting 60%, 420 into Qs, 210 into Berkshire, and 10%, $70 into energy. Do it that way. Berkshire is interesting. I guess they are a sort of a barometer for the economy, given the portfolio that they hold, and given the companies that they own outright. They own paint, they own railroads, consumer goods. So they own a number of things, a cross-section of the economy that, if you were going to find an indicator for the economy, probably be a good indicator. And with active management on it, yeah, I can see that, but I don't know that I would do 100% in equities. Given our current environment, I'm interested in looking at the performance of the S&P 500 over the next 5 years after an inversion of the 3-month tenure. After an inversion or after an uninversion? What would be the best source for data to examine this? Would you use Fred? Fred would have you need just a time series. And what you're trying to do is look at the performance of the S&P over the next 5 years, after the inversion or after the inversion ends. Just look at Fred. You can find just looking at the 2-year, 10-year, let's say, or the 3-month, 30-year, you can see where it inverts and where it uninverts, and then you can use that as your starting date and look at a 5-year history of SPY after that. And look at that date. Take a date 5 years in advance, look at the two different prices between SPY, and calculate a geometric return. So how you would do that is, let's say that this is Fred, and let's say you're watching the 3-month 30, and it inverts and then it uninverts. I don't know if you're looking for the day that it inverts or the day that it uninverts. If it's a day that it uninverts, have a look at what SPY is on that day. Go out 5 years, have a look at what SPY is on that day, and you would take SPY, whatever the value is, over SPY, whatever the value is here, to the 1/5 minus 1, and that will give you a geometric rate of return. A company like BCE could be good use case for communications, as they do both telecom and media. Bell, yeah. Difference between repo and reverse repo, already explained that. Launching the Big Short again on the plane, was confused with the terminology. Can you explain the trade that these savvy investors made? They purchased credit default swaps and mortgage-backed securities. Yep. Waited for those MBS to go bust when their lower credit-worthy mortgages stopped making payments and went into foreclosure. So a credit default swap, when you buy a credit default swap, I want you to think of a CDS as insurance, right? As insurance. Think about, instead of a credit default swap, imagine it's a house. You bought insurance on a house, and the house burns down. The insurance pays off. You get that? That's what it is. It's insurance on the spread. So they bought insurance on the spread. It's a credit default swap. It's a swap. So they swap things. If you are the owner of the CDS, you're going to pay a premium. Those are called insurance premiums. When you buy insurance on your house, you pay insurance premiums, and if the house burns down, you get compensated for it. So you'll pay premiums in exchange for protection. That's what we're swapping. That's why it's a swap. Default, credit default. Now, if these bonds go to zero, these whole things pay off, right? If your house burns down, you get the cash for it. So the difference between the house and the bond is I cannot insure my neighbor's house against fire. I must own the property that I'm insuring, but I do not have to own the bond on which I'm insuring. So I say I want to buy default insurance on that bond right there. And if it does default, then I make out really big because I get paid out the difference between the redemption value of the bond, the face value of the bond, and what the bond is worth. In exchange, I pay a premium over time for that insurance. That's all that is. If I'm long CDS, I am short credit quality, right? If you're long a CDS, you're short the credit quality. So if the credit quality deteriorates, your CDS pays off. They mentioned collateralized debt obligations. What are those? Well, you know what a mortgage-backed security is. It's a bond, and behind it there are a whole bunch of real mortgages, and this is the mortgage-backed security. Well, a CDO just means there's a whole bunch of debt obligations back here, whatever they happen to be, wrapped up into inside a wrapper, inside a bond here, and this is the collateralized debt obligation. It's a debt obligation that is collateralized by other forms of debt. Is it possible to see an increase in productivity while also seeing a decrease in employment? Yes. If I have 10 people making 100 items a day and I get rid of one and they continue to make 100 items a day, there's a productivity gain because now I only have 9 people making the same output. If I get rid of another one and the output drops by a bit, let's say it goes from 100 to 97, but I have 8 people making 97, the output per person could still increase. So yes, you can get productivity gains by reducing employment. For example, automation and AI should increase productivity growth. Yep. And in turn, increase potential GDP. Yep. This allows firms to produce, when they say increase potential GDP, how that works, if we're looking at a Cobb-Douglas production function, is if we think about growth looking like this. This is a capital per labor ratio here, and this is output per labor ratio here. The more capital you add, it doesn't add to growth as much. So the more capital you add, the less effect it's going to have on growth. That's called capital deepening, if that's all you're doing is adding capital. But if you're adding better capital, what happens is you increase this. This is called technological advancement. So rather than having this type of growth rate, you now have this type of growth rate. I'm just drawing a tangent line to where we happen to be. You end up on a steeper part of a curve at a higher curve. So that is what AI can do, is it can make equipment more productive. It's not just that you have another bulldozer, it's that you have a bulldozer that now does the work of two without a driver, right? That's technological advancement. And that does increase potential GDP. This allows firms to produce the same amount of output with less resources and labor. Yep. Could we see an increase in output, but at the same time see a decrease in the overall level of employment? Yes. Yes, you could. I don't know that that would be economy-wide. That would be industry-specific, because the economy would adapt very quickly, because you have employment coming in to this sector that is producing the technological advancement that needs to be done. And if a company gets that done, you're going to have other companies that copy it, that create more employment here but lose some employment over here. And then they'll go and retrain and get something else, or worst case scenario, some people become what's called structurally unemployed, which means the economy has moved to a point where their skill set no longer fits and they are now unemployable. Any thoughts on the 275 basis cut prediction by UPS? That is not a a prediction. It is what's called a conditional prediction. In other words, they're saying if recession, then 275 basis points. They're not saying 275 basis points. They're saying if recession, then 275 basis points. That's a conditional statement. It's 275 basis points if a recession shows up. And it's all premised on the recession showing up. How is the federal funds rate futures different from the market implied probability from the Fed watch tool? They are not. The probabilities from the Fed watch tool are derived from the federal funds futures prices. Communications and media, definitely machinery. Communications is snooze fest. Maybe do that one last. The only better money incinerator than TLT is telecoms. Does CFA help with finding equity research analyst roles? I don't know if they help finding you the job. I think a closer place to be for that would be the CFA societies. But they certainly help in giving you the credentials for which somebody would consider you for that role. Any views on Volkswagen? Not really. Does not have the UAW troubles and trades at very low valuation despite great brands. German-based company. Labor laws in Germany are really strict. It is very difficult to fire someone in Germany. So in essence, you do have a union. Much tougher labor laws in Germany. Does 320 for applied series give lifetime access? For now, yes, it does. Until I hit a certain number. Once I hit a certain number of subscribers, it is going to change to a different model. But for now, for those who get in under that time frame, then yeah. But we're not near that number, so it's not like that's going to end anytime soon. But just be aware that it is going to end at some point. At some point, it's going to have so much content and so much value that a lifetime access for a given price would seem to be, a little light. So it will change in time. I just don't know when and I don't know what. But for now, it's just going to stay the way it is. It is you pay once, and if you're in when I change the pricing, you're grandfathered in. Nothing would ever change for you. Machinery and defense for industrials and communication, media and entertainment. Top 3 preferences: aerospace and defense, entertainment, and machinery. CPI predictions for tomorrow. Well, predicting is just a big guess. Maybe Tesla, Musk knew exactly what they were doing, and Musk was simply trolling as many hate. Oh, that's right. It's bullish. I showed the pictures of the Tesla Cybertruck, and if you're a fan of Tesla, no matter what Tesla does, there's always a bullish angle. Always a bullish angle to what they're doing. Their margins have been dropping for 7 quarters. Yeah, but that's bullish, don't you see? That's bullish. their growth rate is been dropping and they're not going to make the 1.8 million. Yeah, but that's bullish, don't you see? Don't you see? No, I don't. No, I don't. I think that's a big risk to sacrifice the product or the perception of product quality just to troll some haters. I think that's a big risk to take with your product. And if that is what is going on, then this is a stupid group of people that probably are their own worst enemies. If that is what you were doing, it would be like me doing an April Fool's joke and shutting down my site and putting up a sign saying Mark Meldrum has left for Venus and will not be returning to Earth, as a joke, and then nobody has access to the site for a day. No, you don't mess with your product. Like, you do not mess with that. There are other ways to troll haters, but I don't know that anybody, and these are not stupid people, so I don't know that any of the thinking was that, hey, I know what we should do. Let's make a really bad version of the truck 25 days before we launch it. And let's bring it to a show where pictures will circulate on the internet just to troll haters. I don't think that's what they were doing. I think that it was a difficult build given one mold for the whole frame. By the way, has anyone thought, have you ever been in an accident and the front end of your car gets smashed in? Let me see if I could draw the front end of a car fairly well here. There's the hood, and then of course you have your wheel well frame here. You have your grille. I'm drawing a 1965 Mustang, I think. And then you have your hood over here. You get into an accident. Well, this is one body panel that gets replaced, right? Well, what happens when the whole vehicle is one cast and you get into an accident? It's not a body panel that needs to be replaced now. Like, what happens? I don't know. You would have to replace the whole thing, wouldn't you? It seems to me that that would be a sort of a big risk. Anyways, I guess if somebody out there has ever worked in a body shop, maybe you can explain that one to me, what would happen in that particular case. Long time watching your series of market outlooks, enjoying it to the deepest piece. However, this week I was a bit disappointed about outlook. Info is great as usual, but I haven't seen a most important piece of information about previous week. With that on board, I want to ask a question. What's the door? What's the door? I don't know what that means. I haven't seen a most important piece of information about previous week. You'd have to share with me what that is. With that on board, I want to know okay, I have no idea what this is. I have no idea what that is. Industrial sector and understanding machinery, please. Okay. If I buy the Applied Series bundle, will I have lifetime access? Yes, you will. Chief Investment Officer for agency, sold 65,000 shares November 8. Any thoughts? When you look at insider sales, what you're trying to look for are big clusters and big amounts of selling. It is very common for executives to sell on a schedule. Bill Gates sold quarterly for years. For years, he sold quarterly, so that when somebody said Bill Gates selling stock in Microsoft, just run the same headline next quarter. So it's very common for these plans to be in place years in advance, and then on certain dates it just happens. But if you start seeing more and more happening, when you start seeing it clustering and it being out of size, so if you look back over the last 3 years and you say, well, has there been a pattern of this person selling a specific number of shares at specific intervals? And if there has, that's all it is. But it is quite common that if you have a bunch of stock options or a bunch of shares, that at regular intervals you will sell a certain number of them period. You'll already have a plan in place, and you just simply let the plan operate. That's quite common. So no, I don't know that 65,000 shares, I don't know that raises any kind of alarms for me. At what, $9, it comes to 500, 600,000, less of course the tax that has to be paid over the course of a given year. Perhaps this was, maybe they wanted to buy a vacation house somewhere. Maybe they wanted to, interest rates are so high, let's pay down the balance of the mortgage. This is quite common. If you start seeing 3 and 4 insiders selling 800, 900,000 shares, 1 million shares, then you start to say, what's going on here? But this, no, not really. Do we have office hour session today? Yeah, so yesterday I couldn't get Chrome to open. It just bounced in my toolbar at the bottom of the screen, just kept bouncing, and when I right-clicked on it, said not responding. Couldn't get it to open. Tried a whole bunch of things, and then I came across something about no hard drive space, so I checked my trash, and I had almost a gig in there. So I emptied my trash, came up with 900, not a gig, sorry, almost a terabyte in there, came up with 900 gig, clicked on Chrome again, and it opened, like in 2 seconds. So if your computer, there's a good lesson, if your computer is acting slower than you think it should, empty your trash bin. It could be that. China is an authoritarian state, but doesn't act like exactly as traditional left governments in developed countries. China government doesn't carry with the cost of public health care program. I think you mean doesn't care what the cost. I don't know if I would agree with that. If you read the 10Ks of the drug manufacturers, a good example, Pfizer, Merck, and even Teva, because I've done those, they all mention China, and they all mention the increased pricing pressure in China, particularly from a source, one particular source, in that China is really rapidly expanding the number of generics it is approving and allowing into the market, which is putting downward pressure on branded drugs and existing generic drugs. So they do care in a sense. They may not finance it the same way other countries finance the purchase of drugs through state plans, but they certainly have policies that introduce intense downward price pressure, at least on drugs. That's why the savings rate is so huge, because they don't rely on welfare state by the government. Well, that is true. There is a lack of an insurance market in China, so the savings rate in China is high in part because households do self-insure. For decades, China didn't use their surplus to deploy Chinese welfare state and opted to invest abroad. China's invested the commercial surplus in treasuries, lowering the financing rate of U.S. More recently, they invested heavily in Silk Road and gold. Politicians in developed countries are happy to engage in. Is there a question here, or is this a political speech? We're happy to engage in structural finance costs by cheap data. Do you consider these things could affect long-term rate of developed countries? No. No, I don't think so, because there's always a China, right? What was in the 80s, what was the China, right? It was Japan. In the 90s, what was the China? It was the Asian tigers. And then you had China. And now what are you going to have? You're going to have India. There's always a China. So no, the leadership in who's going to be the next, who's the China changes over time. So no, I'm not. I don't know that is one country big enough to affect much more than a little bit, but certainly not lead everything. No, I'm not. I don't know that I would go much into that. Industrials first. Industrials, machinery. Are you Scottish? No, I'm not. Will you add more to the top-down section? Yeah, there's 2 more phases of the business cycle. There is contraction and recovery. But it's hard to do contraction other than theoretically, unless you're actually in a contraction and you can actually point to things. But other than doing it historically, in other words, here's what happened in the last contraction, doing it theoretically, there's not a lot you can do other than wait for the contraction, say, aha, now is the time to do it, because that's what we have right now. And that's it.